What if you could build a trading strategy that aims to make money not by betting on market direction, but by finding these hidden relationships between stocks?
Yeah, and capitalizing when those relationships just temporarily get out of whack.
It sounds a bit like, I don't know, financial alchemy, doesn't it?
Maybe. But it's actually a very real technique. Sophisticated investors, quant funds, they've used it for decades.
And that's what we're diving into today, right?
Yeah.
Specifically, statistical arbitrage pairs trading, looking at how modern tools, sophisticated stats, are used to find these connections in U.S. stocks.
Exactly. And what's really fascinating, I think, is the premise. Individual assets might seem random, right? They just wander. But some are actually bound together. Underlying economic forces, market forces, creating this stable, long-term equilibrium.
Okay.
So our mission, really, in this deep dive is to explore the methods, the specific methods and the sources for identifying these pairs in the U.S. market.
And validating them.
Yeah, validating their relationship, using powerful statistical tests, modeling their behavior, understanding the backtest results, basically giving you a shortcut to understanding how this complex corner of finance works.
Right. We've got quite a bit of material here.
Yeah.
Covers the basics, the intense data requirements, the heavy statistical lifting involved, specific findings from studies using, like, high-frequency data.
Yeah.
And crucially, the real challenges, the limitations. This isn't some guaranteed money machine.
Definitely not.
So if you've ever wondered how quant traders try to find those elusive arbitrage opportunities, or how stats are applied right at the sharp end of finance, well, stick with us. So, okay, let's unpack this first. At its core, what is pairs trading?
Okay, so pairs trading, fundamentally, it's a market-neutral strategy, and that's a really critical distinction.
Okay, market neutral. Different from just buying stocks hoping they go up.
Exactly. Different from traditional investing or directional trading where you're betting on the market or a specific stock going up or down. Here, the goal is to profit from temporary price discrepancies.
Discrepancies between
two securities that have historically moved together in a, well, predictable way.
So market neutral means the overall direction of the S&P 500 or the NASDAQ.
Yeah.
That's not the main driver of profit or loss here.
Precisely. The sources really highlight its potential robustness, suggesting it can perform even in volatile markets or stagnant ones.
Why? Because it's not betting on the whole market.
Exactly, because the strategy isn't taking that directional bet. You're betting on a relative movement between two assets, not their absolute price changes driven by, overall market sentiment.
Fascinating. So, okay, the mechanism. How does it actually work? You find these two related stocks. Then what? What's the actual trade?
Right. You identify two stocks whose prices usually keep a certain relationship, moving together more or less over the long run. Then you wait.
Wait for what?
You wait for the relative prices to diverge. Imagine, like, one stock's price spikes up, the other lags behind. It disrupts their usual balance.
So one gets relatively overpriced, the other underpriced.
It's exactly. Relative to each other. And when that divergence hits a certain point, that's when you execute the trade.
Which means you short the one that went up too much and buy the one that lagged behind.
Precisely. You simultaneously short the stock that's become relatively overpriced, and you go long, you buy the stock that's become relatively underpriced.
Okay.
And the whole premise, the entire bet, is that this divergence is temporary. It's all about the spread between them converging back to its historical relationship.
And the profit comes when that convergence happens, when the gap closes.
Exactly. If you shorted the overpriced one and its price drops, and you bought the underpriced one and its price rises, that closes the gap. You make money on both sides.
Both legs of the trade.
Right. But even if, say, both prices go down, but the one you shorted goes down more than the one you bought, the relative gap still closes. You still profit. It's all about that relative movement, the convergence of the spread.
Got it. It's like betting on a system that it naturally wants to return to some kind of balance point.
That's a perfect way to put it. Actually, the sources have a couple of nice analogies for this. One is the titter-totter.
Yeah, I think I saw that. Like a playground seesaw.
Exactly. You're looking for that balance point. The two sides might swing up and down, but there's that central pivot they keep revolving around. One side goes up, the other down, but they're fundamentally linked, right? They tend to stay in relative balance.
Makes sense. What was the other analogy?
Another one, which I think is quite good for stressing the long-term relationship despite short-term noise, is like two marathon runners keeping a similar pace.
Okay.
They might not be perfectly stride for stride every single second. One might pull slightly ahead on a corner, the other might slow down a bit on a hill.
Right.
But over the long haul, the whole 26 miles, they stay relatively close. They're bound by their training, their endurance level, so if one suddenly sprints way ahead or falls way behind...
The expectation is they'll get back near each other eventually, based on their history.
Exactly. That long-term linked pace, not just momentary identical steps.
I like that one. And you mentioned this isn't like a brand new idea.
No, not at all. The sources trace its origins back to a group at Morgan Stanley, mid-1980s.
Wow, okay.
Yeah, initially it was a proprietary thing within investment banks.
Yeah.
They had the data, the computing power back then, so it's got a solid history, but it's constantly being refined, adapted, new data, new statistical techniques, much more computing power available now.
Okay, so the core idea is clear. Find related stocks, wait for divergence, bet on convergence. But finding those marathon runners, the right partners, that seems like the really hard part, right? How do you even start looking thousands of stocks out there?
That's absolutely where it gets technical and very data intensive. The sources lay out this multi-step approach for pair selection. First, you got to define your universe.
The pool of candidates.
Right. One study we looked at, it focused on U.S.-based companies, market cap over $1 billion.
Why start with the big ones? Are they just more stable or easier to trade?
Well, focusing on large cap, liquid stocks, think S&P 500 components, for instance, offer some big practical advantages. Liquidity is absolutely key.
Especially for the short selling part.
Exactly. You need to be able to easily borrow shares to short and then buy them back later without moving the price too much against you. Big established companies usually have more shares trading, tighter spreads, makes it easier. Plus, they tend to have longer, cleaner historical data, which is the foundation for all the statistical analysis.
Right, the data.
And that brings us right to the data itself. You need high-quality, extensive historical data, market cap, returns, prices, often really granular, like minute-by-minute data.
Where do you get that?
Sources mention platforms like Refinitiv's data stream or using Python libraries like the EOD API to pull this stuff programmatically.
And I'm guessing processing all that data, especially high-frequency stuff, isn't just clicking download.
Oh, far from it. The sources are really clear. Data quality, data availability.
Yeah.
These are huge fundamental challenges in stat arb. You have to meticulously clean it, handle missing values, remove duplicates, adjust for corporate actions, stock splits, dividends. They distort the price series if you don't account for them.
Yeah.
You need to filter it based on trading volume, listing status. It's that classic garbage in, garbage out problem. Inaccurate data, incomplete data, biased data. It can completely wreck your statistical analysis, skew your findings, lead to strategies that look great on paper but just fail miserably in live trading.
Because the relationships you thought you found weren't real.
Exactly. Or you run into biases like sample bias if your history isn't representative, or selection bias in how you picked stocks. And of course, getting that real-time, high-quality data, that costs money, sometimes significant money.
Okay, so step one is a huge data wrangling exercise, assuming you survive that. How do you narrow down the thousands of possibilities to find potential pairs?
You start with initial screening, looking for similarity. The goal here is just finding pairs whose price movements have been historically aligned, at least somewhat.
How do you measure that similarity?
One method to mention is calculating the squared mean squared distance, MSD.
MSD. Okay, break that down. What's it measuring intuitively?
Okay, think of it like this. For every day, or maybe every minute in your history, you look at the return for stock A and the return for stock B. Find the difference between those returns, square that difference, then average all those squared differences over your whole historical period.
So a small MSD means their returns were very close day by day.
Exactly. It measures the average squared difference between their returns. Small MSD means they moved very similarly during that formation period. Their price paths stayed close, so they're candidates.
Okay, looking for minimal difference in returns. What else?
Another common method is the Pearson correlation coefficient.
Ah, correlation. That feels more familiar.
Right. Measures the linear relationship. Ranges from -1, perfect negative correlation, to +1, perfect positive. You'd look for pairs with high positive correlation, close to +1. Suggests their prices tended to move in the same direction.
So if two stocks have like a 0.9 correlation over a few years, that's a pair, right? Found one, they move together.
Okay, now this is where it gets really interesting. And it's maybe the most crucial statistical point the sources make for robust pairs trading. High correlation is not enough.
Really? Why not? If they move together 90% of the time.
Because correlation just measures short-term linear association. two stocks might be highly correlated for a while just because, I don't know, they're in the same hot sector temporarily, or general market sentiment pushes them both up. It doesn't mean there's a fundamental, stable, long-term link. They could be correlated, but their individual prices might still be wandering off independently. And crucially, the difference between them, the spread, might also be wandering, never settling back to a consistent average.
Ah, okay. Like our marathon runners might run side by side for a mile just because they started together, but they aren't actually tied together for the whole race. One could just veer off later.
Precisely. If there's no underlying statistical force pulling them back together, a divergence could happen and they might just drift apart forever. That's disastrous for pairs trading.
You'd lose big time if the spread never came back.
Exactly. The sources warn about these spurious relationships, correlations that look strong but lack a real economic or statistical basis for a long-term equilibrium. Trading those is pure gambling on the spread coming back. That's why you need something stronger.
Which brings us to
the real heart of this. Cointegration.
Cointegration. Okay, sounds statistical. Let's dig into it. What exactly is cointegration and why is it so fundamental here? Why is it the key for statistical arbitrage?
Right. Cointegration is the key property that turns pairs trading from, a potentially risky bet on correlation into something grounded in the statistical expectation of mean reversion, because it points to a stable long-term relationship.
Okay.
So individual stock prices, they're often non-stationary.
Hold on. Non-stationary. What does that mean in plain English?
Okay, statistically, a time series is non-stationary if its basic properties, like its average value, its mean, or its variance, change over time. Think of a typical stock price chart over years. It generally trends upwards, right? It doesn't have one fixed average level it keeps returning to.
It wanders.
It wanders, exactly. Its level changes. Most individual stock prices are non-stationary. Statisticians might say they follow a random walk or have a unit route.
Like that marathon runner just jogging across the country. Their location keeps changing, not tied to one spot.
Perfect analogy. They just wander. Now, here's the magic of cointegration. Even though two individual series, like two stock prices, might each be non-stationary and wander on their own, cointegration means there's some kind of constant equilibrium mechanism tying them together in the long term, so that a specific combination of them.
Like the difference between them.
Exactly. Or more precisely, the difference between their prices, maybe adjusted by some ratio. That combination is stationary.
Okay, so they wander, but they wander together, like they're on a statistical leash. Or are runners tied together with a rope?
That's the intuition. The individual series drift, but the spread between them, that difference, remains stable. It fluctuates around a fixed mean over time. And that property, the spread being stationary, meaning it tends to return to its mean, that's absolutely essential for pairs trading.
Why essential?
Because if the spread doesn't show this tendency to revert to its mean, there's no statistical basis for betting on convergence. A trade based on a diverging spread, if it's not mean reverting, is just speculation, not statistical arbitrage. Which brings us back to that crucial distinction we touched on, cointegration versus correlation. Let's really nail this down.
Yeah, you said correlation is short-term association, cointegration is long-term equilibrium. Spell that again.
Okay, correlation. How much do two things move together right now, or over some recent period? It's about immediate linear relationship strength. You could have two totally unrelated things that just happen to move together for a bit, showing high correlation. Pure chance, maybe, or some temporary external factor.
Okay.
Cointegration, much stronger concept. It asks, is there a stable long-term equilibrium between these non-stationary series, such that any deviations from that equilibrium are temporary, they tend to get corrected over time?
So cointegration is like the statistical proof that the rubber band actually exists between them, that there's a real long-term force pulling them back together if they stretch too far apart.
Precisely. It confirms that stable long-term link. That's the foundation you need for a mean reverting pairs strategy. Without cointegration, that spread might just wander off and never come back. You could face unlimited losses on the short side.
Okay, the importance is crystal clear now. Cointegration is the non-negotiable. So how do you actually test for it? How do you get that statistical proof, that rubber band confirmation?
Right, so there are statistical tests. A widely used one, mentioned in the sources, is the Ingle-Granger two-step test. It's pretty standard in time series econometrics.
Ingle-Granger. Okay, walk us through the steps. How does it work for stock pairs?
First step, you run a regression, ordinarily squares OLS, You regress the price series of one stock against the price series of the other. Usually log prices, actually, to stabilize things.
Okay, finding the best line that fits their historical relationship.
Exactly, over your historical formation period. And the coefficient you get on the second stock in that regression, that's often used as your hedge ratio.
Hedge ratio, meaning how many shares of stock B you need to balance one share of stock A?
Sort of, yeah. It tells you the relative quantity needed to create a potentially stationary combination based on their historical average relationship.
Okay, so regression gives the average relationship and the hedge ratio. What's step 2?
Step 2 is the crucial one. You look at the residuals from that OLS regression.
Residuals?
Yeah.
The errors. The difference between the actual prices and the regression line.
Exactly. At each point in time, the residual is the difference between the actual relationship, the actual price difference adjusted by that hedge ratio, and the relationship predicted by your regression line. These residuals represent the spread we keep talking about, the historical deviations from that estimated long-term equilibrium.
And then you test those residuals. Why the residuals?
This is the core insight of the Ingle-Granger test. If the two original price series really are co-integrated, then this specific linear combination of them, which is what the residuals represent, the deviation from their stable link, that combination should be stationary.
Okay, let me process that. The regression finds the average long-term path. The residuals are the wiggles away from that path.
Right.
So if those wiggles always tend to come back to zero.
Meaning they fluctuate around a fixed mean, which is 0 for residuals, and have constant variance.
Yeah.
Then that proves the average path you found is a real stable center point. It proves cointegration. You got it. You're testing if the deviation is stationary. If the deviation reliably returns to 0, the underlying relationship must be stable and mean reverting.
Okay, so how do you test if those residuals as deviations are stationary?
The sources mention using the augmented Ducky-Fuller test, the ADF test.
ADF test, right? That's a standard test for stationarity for checking if something just wanders randomly, isn't it?
Yes, exactly. It specifically tests for a unit root, which is the statistical signature of non-stationary wandering series. The ADF test gives you a test statistic and, more importantly, a p-value.
The p-value always comes down to the p-value. What does it tell us here?
Okay, this is where you get your answer. The null hypothesis for the ADF test, when you apply it to these residuals, the null hypothesis is that the residuals are non-stationary.
Meaning the pair is not cointegrated under the null.
Correct. So if the p-value you get from the ADF test on the residuals is small typically, the convention is less than or equal to 0.05, a 5% significance level. And then you reject that null hypothesis. You have enough statistical evidence to say, no, the residuals are stationary.
And stationary residuals mean?
Stationary residuals mean the pair of stocks is statistically cointegrated. It indicates that long-term stable equilibrium exists. Crucially, it means the spread is mean reverting. This validates them as suitable candidates for a pair's trading strategy based on that mean reversion.
So low p-value on the ADF test of the residuals equals cointegrated pair equals potentially tradable.
That's the logic. And if the p-value is high, say greater than 0.05.
And you can't reject the null.
Right. You can't reject the hypothesis that the residuals are non-stationary. So the conclusion is the pair is not cointegrated, according to this test. They might be correlated, maybe even highly correlated, but that stable long-term link isn't statistically supported. Their spread could just wander off. Unsuitable for the strategy. Discard the pair.
Okay, that's a rigorous process. Define universe, get clean data, screen for similarity, MSD correlation, run OLS, get residuals, run ADF on residuals, check p-value. That's the key filter.
That's the statistical core of it. And the sources give some really clear examples, like they tested United Airlines and Delta Airlines.
Okay, 2 airlines. Makes intuitive sense they might be related.
And the test showed significant cointegration. The ADF statistic was around megas 12.0, and the p-value was basically 0.000.
0 p-value. That's way below 0.05. Very strong evidence.
Exactly. Suitable for trading based on this method. But then they tested another pair. Credit Corp Ltd. And Farmers and Merchants Bank.
Doesn't immediately sound related.
And the test agreed. ADS statistic was about megit 0.25, and the p-value was 0.9779.
Whoa, 0.9779. Very high, way above 0.05.
Totally. No statistical evidence of cointegration there. Filtered out immediately. Unsuitable. The sources also mention looking at, say, Apple and Microsoft, AAPL and MSFT.
Yeah, big tech rivals, long history.
Right. You'd run these same tests on them to see if statistically a cointegrated tradable link exists despite their rivalry or maybe because of it.
And after all this heavy statistical lifting, the sources mention quants often add a manual review step.
Yeah. It's often pragmatic. Statistics are powerful, but a final qualitative check helps. Look at their industries. Are they really competitors? Do they share suppliers, customers? Is there a logical reason why they should be linked long-term?
Adds a sanity check to the numbers.
Exactly. Helps maybe screen out spurious relationships that somehow pass the tests, or prioritize pairs where the fundamental story backs up the statistics.
Okay, so we've done the hard work, identified statistically validated cointegrated pairs. We're confident their spread should revert to the mean. Now, how do you actually trade it? How do you know when to jump in and out?
Right. Now we shift from identification to modeling the spread's behavior and setting up the trading rules. Once you have a cointegrated pair, your focus is entirely on the spread.
The difference between their prices,
Right.
adjusted by that hedge ratio.
Correct. That spread is the time series you watch you trade, because it's the thing that's supposed to be stationary and mean reverting. And here's where it gets quite sophisticated. Quants often model this mean reverting behavior using a specific mathematical process. It's called the Ornstein-Uhlenbeck process, OU process.
Ornstein-Uhlenbeck, okay, sounds involved. Give us the intuitive feel. What's this OU model doing for the spread?
Okay, think of the OU process as a mathematical description tailor-made for things that tend to get pulled back towards a central value over time, but also get randomly bumped around.
Like our spread. Pulled back to the mean, but with market noise.
Exactly. It's used in physics, actually. Modeling velocity of a particle in fluid subject to drag and random kicks. Turns out it's a really good fit for modeling financial spreads that are co-integrated and expected to mean revert.
So it captures both the rubber band snapping back tendency and the random market noise.
Precisely. It models the spread's movement as having two parts: a deterministic pullback towards its mean the drag or snapback, and a stochastic random part, the noise. And the OU process has specific parameters describing this, usually called lambda, mu, and sigma.
Lambda, mu, sigma, what do they represent?
Lambda tells you the speed of mean reversion. How fast is it snapback? Higher lambda, faster snapback. Mu is the long-term mean level the spread reverts to, its equilibrium point. And sigma represents the volatility, the size of the random kicks around that mean.
And you can figure out these parameters, lambda, mu, sigma, for a specific pair's spread from the historical data.
Yes, exactly. The sources show you can actually rearrange the math behind the OU process into a form that looks like a linear regression. So you run the special regression on the historical spread data for your pair. The coefficients you estimate from that regression allow you to calculate the OU parameters, lambda, mu, sigma, for that specific spread. This gives you a rigorous mathematical description of how that spread behaves. Its natural resting place, mu, how quickly it returns, lambda.
So the OU model gives you this deep quantitative profile of the spread's personality. How do you turn that into actual trade signals? When do you hit the buy-sold button?
You typically translate it using z-scores.
Z-scores, standard deviations from the mean.
Exactly. The z-score standardizes the current deviation of the spread from its mean. Maybe estimated from the OU process or just a historical average. It tells you right now how many standard deviations away from its average level is the spread.
Okay, like if the z-score is plus 2.0, the spread is currently 2 standard deviations wider than its average.
Correct. And these z-scores, or sometimes just the raw spread divided by its standard deviation, become your primary trading signals. Trades get triggered when the spread, or its z-score, goes beyond some predefined threshold,
Signaling that the divergence is statistically significant enough to bet on mean reversion.
That's the idea. It's stretched far enough from its usual level that, based on its historical behavior, modeled by OU or similar, it's likely to come back.
What kind of thresholds are we talking about? Is it always, say, 2 standard deviations?
The sources discuss different examples. A common approach is entering when the z-score crosses, say, plus minus 2.0 or maybe plus minus 2.5.
Okay.
So if the z-score hits plus 2.5, the spread is wide. Stock A is significantly overpriced relative to stock B's signal. short A, long B,
Yeah.
using the hedge ratio.
And if it hits minor 2.5?
Spread is narrow. Stock A is undervalued relative to B signal, long A, short B. Then you typically exit when the spread converges back towards the mean. Maybe when the z-score crosses back through plus minus 0.5, or even just hits 0. Another way they phrase it is opening when the spread diverges by K times its standard deviation.
And did the studies find a particular K value that worked well?
Yeah, one study specifically highlighted that using K 2.5 entering when the spread hit 2.5 standard deviations from the mean produced strong results, especially when combined with a certain pair selection method.
Interesting. Now, are these thresholds, these plus minus 2.5 bands, are they fixed or do they change?
That's another really crucial detail from the sources. Turns out how you define those trading bands makes a big difference to performance. They looked at 3 main ways.
Okay. 1, static thresholds, S, calculate the mean and standard deviation from a fixed historical formation period. Set the plus minus 2.5 or whatever bands based on that. And those bands stay fixed for the whole trading period afterwards.
Okay, fixed bands. What else?
2, time varying thresholds, much more dynamic. Here, you use a running mean and standard deviation, calculated over a recent moving window of data, maybe the last few hours or days.
So the mean and standard deviation are constantly updated.
Exactly. As new data comes in, minute by minute, you recalculate. So your trading thresholds, your plus minus 2.5 bands, are constantly adjusting over time, reflecting the spread's most recent behavior.
Adaptive thresholds.
And the third.
3, reverting thresholds are. This one's a bit different in logic. It only opens a trade after the spread first crosses a band, diverges, and then crosses again, coming back the other way, starts reverting. It waits for that little bit of confirmation that it's turning around before jumping in.
Okay, 3 approaches. Static, varying, reverting. Which one worked best in the back tests?
The findings were pretty clear. The dynamic approach, the time-varying V thresholds, were significantly more effective, especially with high-frequency data like the minute-by-minute stuff they used.
Why? What makes dynamic better than static?
Well, the sources explain that dynamic thresholds V are better because they automatically adjust to reality. Market dynamics change, right? The spread's average level might subtly drift over long periods. Volatility comes in clusters. Markets aren't static.
And static thresholds miss that.
Exactly. Static thresholds, S, are based on old history. They fail to capture these shifts. You might miss trades because the spread's normal has drifted, or you might trade against a spread that's actually found a new equilibrium level. The dynamic bands adapt.
Makes sense.
And the study found that strategies using these varying thresholds, V, led to more frequent, quicker round trips. Trades opened and closed more often and faster.
Which is good.
Generally, yes, for systematic strategies. It means you reinvest capital faster and you reduce your exposure time to any single position's risk. Static thresholds sometimes led to trades staying open for ages, maybe never converging back to that old static mean, and having to be forced closed later, potentially at a loss. Dynamic is just more adaptive.
Okay, so we've got a sophisticated process. Find pairs using similarity and co-integration tests, Engle-Granger ADF. Model the spread, OU process. Trade using dynamic, time-varying thresholds based on deviations like z-scores or K 2.5 standard deviations. That's a lot of steps. But the big question, does it actually work? What did the studies find about performance? Back-tested performance.
Right, the bottom line. And yeah, one study we looked at closely did a really rigorous backtest, used high-frequency, minute-by-minute S&P 500 data, spanned a long time, 1998 to 2015. That gives some pretty compelling insights.
Wow, 17 years of minute-by-minute data. That's serious. What did they find?
Exactly. Very granular, long horizon, reflects how pros might trade this. The key finding was that one specific combination of methods really stood out. It was using Euclidean distance, E, for the initial pair screening.
Euclidean distance, similar to MSD, measuring how close price paths stayed.
Yeah, basically finding pairs whose price paths were geometrically closest historically, and combining that with the varying thresholds, V, for the trading rules, those dynamic adaptive bands we just talked about.
So E for selection, V for trading. The EV strategy.
They called it the EV strategy, yeah. And its performance was, well, pretty remarkable.
Lay the numbers on us. What did the EV strategy do over that 1998-2015 period?
Okay, get this. And this is after accounting for estimated transaction costs, which is crucial. Over that period, the EV strategy achieved a 50.50% annualized return.
50% annualized.
50.50%, and an 8.14 annualized Sharpe ratio.
8.14 Sharpe ratio. That's insane. Let's unpack that. 50% return is obviously huge, but Sharpe ratio measures risk-adjusted return, right? How much bang for your buck, risk-wise?
Exactly. Return per unit of risk, basically volatility.
And 8.14 is, for context, a Sharpe of 1 is often considered good for hedge funds. Over 2 or 3 is excellent. 8.14 over 17 years. That suggests an incredibly efficient capture of returns relative to the risk taken. Almost sounds too good to be true, but suggests a real statistical edge was being exploited, at least historically.
It really does speak to the potential power of doing this right.
Yeah.
The right selection, the right adaptive trading rules.
Were there other good signs? Other positive characteristics of the returns?
Yeah, the sources mentioned a couple of other things quants like to see. The EV strategy's returns showed right skewness. Meaning the distribution of returns had a longer tail on the positive side. Suggests large winning trades were more frequent or bigger than large losing trades, a good asymmetry. They also showed a leptokurtic distribution, fatter tails, higher peak than a normal bell curve. Now, fatter tails usually mean more extreme events, but combined with the right skewness and low tail risk, it actually implied a higher chance of those really big positive returns and fewer extreme negative ones than you might expect. And speaking of tail risk, the strategy showed greatly reduced tail risk compared to just holding the S&P 500.
Oh, reduced.
They looked at historical value at risk, VAR, at the 1% level. That's like your estimated worst loss on the worst 1% of days. For the EV strategy, it was only negative 0.32%. For the S&P 500 over the same time, negative 3.50%.
Wow. So much smaller potential losses on really bad days compared to the market.
Significantly smaller. So you've got high returns, amazing risk-adjusted returns, tendency towards big wins, and much less exposure to extreme losses. Pretty compelling picture from the backtest.
It really is. Anything else significant?
Yes. One more really important finding. This strategy showed almost no loading on common systematic risk factors.
Unpack that. What does no loading mean? Its profits weren't just secretly coming from market movements or style factors.
Precisely. The returns from the EV strategy couldn't be explained by the usual suspects that drive most investment returns. Things like overall market risk, beta, or exposure to small caps, SMB, or value stocks, HML, or even newer factors like profitability, RMW, or investment style, CMA.
So it wasn't just riding a market wave or a factor trend.
Nope. This strongly supports the idea that it was capturing genuinely unique, statistically driven opportunities, the arbitrage part, distinct from just taking on typical market risks. The edge seemed to come purely from exploiting these specific relative mispricings.
Did it work consistently? What about during tough times like crises?
Yeah, they looked at sub-periods and reported strong performance specifically during market turmoil. Mentioned the dot-com crash, early 2000s, and the global financial crisis, 2008, 2009.
So it held up, or even did well, when markets were melting down.
Seems so, which confirms that market-neutral idea. It's designed not to depend on the market going up and might even thrive on the extra volatility and dislocations during crises.
Incredible. A strategy that potentially makes a good money with low risk, especially when everything else is tanking, sounds perfect, but there's always a but, isn't there?
Yeah, usually. And the sources are careful to include an important note of caution. It aligns with other academic work, too. They confirm a general finding that pairs trading strategies, in general, show a declining trend in profitability over very long time horizons.
Ah, the market efficiency strikes again.
That's the usual explanation. As more quants, more funds identify and exploit these stat arb opportunities, the inefficiencies get smaller, they get arbitraged away faster. More competition for the same trades leads to lower returns over time compared to, say, the 80s or 90s.
So the golden age might be over.
Well, maybe for the simpler versions. But and this is key, the study emphasized that sophisticated variants, like their EV strategy, still achieved pleasant performance even in the later years of their study, like 2013, 2015, years when competition was definitely higher.
Okay, so the simple stuff might be dead, but advanced approaches can still work.
That seems to be the implication. The edge still exists, but you need state-of-the-art methods, robust selection, dynamic rules, requires constant adaptation and sophistication to stay ahead.
So the back-tested numbers for EV are amazing, but it's not a static picture. It's a competitive, evolving landscape. And there are real-world hurdles.
Absolutely. Those back-tested results show the potential, but it's crucial, really crucial, to balance that with a realistic look at the difficulties, the limitations in actually doing this live. It's powerful, but absolutely not a panacea. The sources are very clear on the challenges.
Okay, let's get into those challenges. If it's potentially so profitable, what's the catch? What makes it hard?
Challenge number one, maybe the biggest. Data. Data is king, right? But getting the right data in the right shape, incredibly difficult.
We touched on needing clean historical data. Why is that such a hurdle in practice?
You need reliable, accurate, comprehensive history. Often high-frequency minute, even tick data. Getting that for thousands of stocks over decades. Complex, time-consuming, often expensive.
And it's never perfect when you get it.
Never. You get errors, missing values, inconsistent formats, mistakes in adjusting for splits or dividends. These aren't small things.
Right, garbage in, garbage out. How specifically does bad data hurt?
It totally messes up your stats. Your co-integration tests might give false signals, finding relationships that aren't real or missing ones that are. Your OU parameters get estimated wrongly. Your thresholds are calculated based on flawed inputs. It just cascades through the whole process.
Leading to bad trades.
Leading to bad trades based on phantom relationships. Plus, you've got biases, sample bias, selection bias. And getting that live, low-latency, high-quality data feed for actual trading, that can be prohibitively costly for smaller players.
So just the data foundation is a massive hurdle, technically and financially. What else?
Beyond data, that market efficiency thing we mentioned, it's constantly catching up.
The competition.
Yeah. More traders, especially big quant funds with huge resources, are deploying similar strategies. They find the same mispricings, trade them faster, the inefficiencies shrink, the profits get competed away. It's an ongoing arms race. You need constant refinement just to keep pace.
Sounds exhausting.
Yeah.
Like you're always battling other smart people.
You are. And in that race, transaction costs become absolutely critical, especially for high-frequency stuff.
Like minute-by-minute trading. Lots of trades, right?
Exactly. Opening, closing positions frequently. Even if your edge per trade is tiny, those costs add up fast and can just eat your profits.
What costs are we talking?
Brokerage fees, exchange fees, but also market impact. Your own trades moving the price against you, especially if you trade size. And the bid-ask, spread the gap between buying and selling prices. That's a direct cost on every round trip.
Have those costs come down?
Explicit costs like commissions have, yeah. Technology, competition among brokers helps. Sometimes high-frequency traders even get rebates for providing liquidity. But they're still real. You have to model them meticulously, minimize them. A strategy that looks amazing before costs might be totally dead after costs.
So even if you find a real edge, the friction of trading can kill it. What about managing the risk? Sounds complex.
Oh, risk management is huge. And complex. You've got market uncertainty, you're using sophisticated models, maybe leverage. It's challenging. The number one risk really connects right back to the core idea, correlation breakdown or co-integration breakdown.
The rubber band snapping, the relationship just falls apart.
Exactly. The historical statistical link your whole trade is based on, it just evaporates.
Why would that happen?
Could be fundamental reasons. One company gets bought, goes bankrupt, huge product failure, shift in the industry. Or really dangerously, during extreme market stress, panic. Correlations just go haywire. Things that used to move together suddenly fly apart, or things that were unrelated suddenly move in lockstep.
And if that happens while you're in a trade?
The spread doesn't revert. It diverges violently, maybe permanently. Huge, sudden losses can wipe out weeks or months of small gains from successful trades.
Ouch. How do you protect against that?
You need robust techniques. Careful position sizing, don't bet the farm on one pair. Strict stop-loss orders, get out automatically if the spread moves too far against you, limit the damage from a breakdown. And diversification, trade in many different pairs across different sectors so one failure doesn't sink you.
And the models themselves, OU process, et cetera, they have limits.
Absolutely. Statistical models are just models. They make assumptions. OU assumes constant mean reversion speed, constant mean, maybe not true over really long periods. And the big one, overfitting.
Overfitting. Explain that in this context.
It means your model looks fantastic on the historical data you used to build it, fits perfectly, but it fails completely on new data in live trading.
Why?
Because it hasn't learned the true underlying relationship. It's just memorized the noise, the specific quirks of your historical sample. Too complex a model maybe, or too much tweaking to fit the past data.
So a backtest looks amazing, but it's useless going forward.
A very real constant risk. An overfit pairs trading model might find spurious relationships, set bad thresholds, requires really careful out-of-sample testing, ongoing monitoring. Plus, other things can affect models. Multicollinearity, if the stocks are too similar, makes the hedge ratio unstable.
So even the best backtest could fall apart live.
It could. And the world changes, right? External factors, geopolitics, regulations, new tech, shifts in how people trade. They can all alter relationships, break models. What worked from 1998-2015 might need serious recalibration today or might just not work anymore. And finally, there's capacity. Some strategies just don't scale well. If too much money chases the same few pairs trading opportunities, the edge gets eroded by everyone trying to push through the same narrow door.
The strategy eats itself if it gets too popular.
Kind of. And don't forget the infrastructure cost. Sophisticated tech for data analysis, execution, skilled quants, engineers. It's expensive to build and run, high barriers to entry.
Okay, so wrapping up the challenges. Data hell. Market efficiency competition constantly eroding edges, transaction cost biting, risk of catastrophic relationship breakdowns, model limitations like overfitting, changing market dynamics, capacity constraints, and high-tech personnel costs.
That about sums it up.
So yes, the back-tested numbers for something like the EV strategy look phenomenal, points to real potential. But it is absolutely not simple. You need top-tier data, stats, tech, risk management, and even then, it's a constant battle against the market and competitors. Fascinating use of stats, but demands huge expertise and resources.
Precisely. High potential reward from exploiting statistical edges, but comes with equally high demands. Skill, tech, capital, constant vigilance. It's a tough game.
Okay, that was definitely a deep dive. Complex, but really fascinating. Let's try to bring it all together. Key takeaways from exploring statistical arbitrage pairs trading, finding cointegrated U.S. stocks with modern tools.
Okay, we started with pairs trading as market neutral, profiting from temporary price divergences between related stocks converging back to their mean.
The mechanism: short the relative winner, long the relative loser, bet on the spread closing, like the teeter-totter and marathon runner analogies.
Then the rigorous pair selection. Define the universe. Liquid stocks, initial similarity screens, MSD, correlation. But crucially, correlation isn't enough. You need cointegration.
Cointegration, the statistical proof of a stable, long-term, mean-reverting relationship between stocks whose prices might otherwise just wander, essential for the strategy.
We detailed the Ingle-Granger test, OLS regression for the average relationship and hedge ratio, then testing the residuals, the spread deviations, for stationarity using the ADF test.
Low p-value on the ADF test of residuals, pick a cointegrated pair, suitable candidate. High p-value, not cointegrated, equal discard. So the United Delta versus Credit Corp example.
Right. Once validated, you model and trade the spread. We talked about the Ornstein-Uhlenbeck OU process to mathematically capture that mean reverting behavior, estimate its speed, lambda, mean level mo, volatility sigma.
Then using z-scores to standardize the spread's deviation, providing trade signals based on crossing predefined thresholds.
And the key finding that dynamic, time-varying thresholds, V, which adapt using running stats, significantly outperform static ones, especially with high-frequency data, often triggering around K2.5 standard deviations.
The backtesting results for the EV strategy, Euclidean distance selection, varying thresholds, were impressive. 1998-2015 S&P 500-minute data, 50.5% annualized return, 8.14 Sharpe ratio after costs.
Plus favorable stats like right skewness, leptokurtosis, much lower tail risk than the market, and almost no loading on systematic factors, suggesting a unique statistical edge. Robust even in crises.
But we balance that with the major challenges: data quality and cost, market efficiency and competition eroding profits over time, transaction costs, the huge risk of correlation cointegration breakdown,
model limitations like overfitting, changing market dynamics, capacity constraints, and the high cost of tech and expertise needed.
So the takeaway for you, the listener: statistical arbitrage pairs trading, especially using sophisticated cointegration tests and dynamic trading rules, is a powerful quantitative approach. It has shown historical potential for high risk-adjusted returns, even when markets are rough. But it's incredibly demanding.
Yeah, requires deep stats knowledge, serious tech infrastructure, great data, rigorous risk management, and constant adaptation. High reward potential, but very high complexity and demands.
Which leaves us with a final thought, perhaps. Despite markets getting more efficient, despite all these challenges, do these statistically linked pairs represent real, fundamental economic connections that might endure? Or are they just temporary patterns, statistical ghosts waiting for the next shock to vanish?
And how will that relentless quant arms race keep shaping profitability? What techniques evolve next? What's the next evolution in finding or trading these subtle relationships as markets keep changing? Something to ponder.